Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Hey, Chris. Happy Monday to everyone listening out there. And I have to say, we have a really fascinating story to dig into today that I think is going to resonate with a lot of business leaders and technology decision makers in our audience.
That is absolutely right, and it comes from a brand new study that PwC just released today, April 13, 2026, called their AI Performance Study. And the headline finding is pretty staggering when you really think about the implications for the broader economy.
So here's the core number that jumped out at me when I first read through this study this morning, and it is genuinely striking. 3/4 of all the economic gains being generated by artificial intelligence right now are being captured by just 20% of companies worldwide.
Let that sink in for a second, because what that means is that 80% of companies out there investing in AI, spending real money on infrastructure and talent and tools, are collectively splitting just 25% of the total economic value being created.
Exactly. And this is not some small sample either, because PwC surveyed 1,217 senior executives at director level and above, spanning 25 different industry sectors across multiple regions around the world. So this is a genuinely comprehensive global snapshot.
So the obvious question that I think everyone listening wants answered is, what are that top 20% of companies actually doing differently that separates them from the rest of the pack in such a dramatic fashion?
Well, and this is where it gets really interesting. PwC found that the biggest differentiator is not what most people would guess, because it is not about efficiency or cost cutting, which is where most companies start their AI journey and frankly, where many of them get stuck.
Right, because I think the conventional wisdom has been to deploy AI to automate processes, reduce headcount, trim operational costs, and that is a perfectly logical place to begin. But you are saying the leaders have moved well beyond that initial phase.
That is exactly right. And the data backs this up in a really compelling way, because companies that applied AI broadly across their products, services, and customer experiences achieved nearly 4 percentage points higher profit margins compared to companies that were primarily using AI for internal efficiency gains.
4 percentage points of profit margin is absolutely massive when you are talking about large enterprises, because at scale, that translates into billions of dollars of additional value creation. So this is not some marginal difference between the leaders and the laggards.
And here's another data point that I think really illustrates the mindset gap, because PwC found that top-performing companies are 2.6 times more likely than their peers to say that AI has fundamentally improved their ability to reinvent their entire business model from the ground up.
That 2.6 times multiplier is really telling, because it suggests these companies are not just bolting AI onto existing processes. They are fundamentally rethinking what their company does, how it creates value, and who it serves in the marketplace.
Right, and the study goes even further by identifying something called industry convergence as the single strongest factor driving AI-powered financial performance, which I think is a concept that deserves some unpacking for our listeners today.
Yeah, I would love to hear you break that down, because industry convergence sounds like one of those consulting buzzwords that could mean almost anything. So what does it actually look like in practice when companies pursue this strategy?
So industry convergence is basically when companies use AI to identify and pursue growth opportunities that cross traditional sector boundaries. And PwC found that the top performers are 2 to 3 times more likely than average companies to actively pursue these cross-industry collaborations.
Can you give us a concrete example of what that would look like? Because I want to make sure our listeners can really visualize how this plays out in the real world rather than just thinking about it as an abstract strategic concept.
Sure, so imagine a healthcare company using AI not just to improve diagnostics, but to partner with a financial services firm to create entirely new insurance products that are dynamically priced based on real-time health monitoring data from wearable devices and predictive AI models.
Oh, that is a great example, because it shows how AI becomes the connective tissue that enables business models that simply could not have existed before, where the value comes from combining capabilities across traditionally separate industries and creating something entirely new.
Exactly. And this is why PwC is saying that convergence is the single strongest factor ahead of efficiency gains alone. Because when you use AI to cross industry boundaries, you are not just doing the same thing cheaper, you are creating entirely new revenue streams and market opportunities.
Now, there's another statistic from this study that I find both fascinating and a little bit alarming, and it comes from the broader PwC CEO survey context, where 56% of CEOs said that AI has delivered zero measurable cost or revenue improvements for their organization.
That is the sobering flip side of this whole story, because more than half of the CEOs surveyed are basically saying that despite all the investment, all the hype, all the pressure from boards and shareholders to adopt AI, they have not seen any tangible financial return yet.
And only 12% of CEOs say they are actually winning with AI, which means roughly 1 in 8 companies feels like they have cracked the code, while the other 7 out of 8 are still trying to figure out how to extract real value from their investments.
And I think that connects directly to one of the most provocative findings in the study, which is that PwC found technology itself only delivers about 20% of the expected value from AI initiatives, and the remaining 80% comes from what they describe as pure grit.
Pure grit is such an evocative phrase coming from a Big Four consulting firm. So what exactly do they mean by that? Because it sounds like they are saying the technology is almost the easy part of the equation,
What they mean by pure grit is the hard organizational work of actually redesigning workflows, retraining people, restructuring teams, changing incentive systems, and fundamentally rethinking how work gets done, which is the messy human side that nobody wants to talk about at AI conferences.
That resonates with something I have been hearing from a lot of enterprise technology leaders lately, which is that the bottleneck is not the AI models or the compute infrastructure. It is change management and organizational readiness that determines whether an AI deployment actually delivers value.
100%. And this is why I think the 2080 split is so important for our listeners to internalize. Because if you are a business leader and you are thinking about AI strategy, you need to be spending at least 4 times more energy on the organizational transformation than on the technology itself.
So let us talk about PwC's methodology for a moment, because I think it adds credibility to these findings. And they developed something called an AI Fitness Index that I want to understand better in terms of how they actually measured and compared these companies.
Right. So the AI Fitness Index is built around 60 distinct AI management and investment practices that PwC identified, and they grouped these into 2 broad categories: AI use, which is how you deploy the technology, and AI foundations, which is all the organizational plumbing underneath.
And I would imagine that the companies in that top 20% scored high on both dimensions, meaning they had strong technology deployment combined with robust organizational foundations, rather than being strong on one but weak on the other side of the equation.
That is exactly what the data shows, and it is actually the combination that matters most. Because companies that invested heavily in AI technology but neglected the foundational work of data governance, talent development, and process redesign ended up with very mediocre results despite significant spending.
This feels like a really important wake-up call for the broader business community, because we have been in this AI gold rush mentality for the last few years where the emphasis has been on adopting AI as fast as possible without necessarily thinking through the organizational readiness question.
And I think what makes this study particularly timely is that we are now far enough into the enterprise AI adoption cycle that we can actually measure outcomes. And the results are showing that the gap between winners and losers is not closing. It is actually accelerating and widening over time.
That widening gap is really the most concerning part of the story, because it suggests we might be heading toward a kind of AI-driven economic inequality at the corporate level, where the rich get richer and the companies that fall behind find it increasingly difficult to catch up.
Right, and there is a compounding effect at work here too, because the companies that are generating returns from AI have more capital to reinvest, they attract better talent, they accumulate more proprietary data, and all of those advantages feed back into even stronger AI capabilities over time.
It is almost like a flywheel effect where early AI success breeds more AI success. And conversely, companies that have not figured out how to extract value from AI find themselves falling further and further behind with each passing quarter as the leaders pull away.
Exactly, and I think this has real implications for the venture capital and investment community as well. Because if you are an investor trying to evaluate companies, their AI maturity and their score on something like PwC's AI Fitness Index may become just as important as traditional financial metrics.
That is a really provocative point, because it suggests that AI capability could become a fundamental input into company valuations, where Wall Street analysts start asking not just about revenue growth and margins, but specifically about where a company sits on the AI performance spectrum.
And we are already starting to see hints of that in how the market values technology companies versus traditional enterprises. But I think what this PwC study does is put hard numbers behind the intuition that AI capability is becoming a critical determinant of long-term competitive viability.
Let me play devil's advocate here for a moment, though, because I can imagine some listeners thinking that this is just another consulting firm trying to scare companies into buying more consulting services by painting a picture of AI haves and AI have-nots that is deliberately alarming.
That is a fair skeptical take, and I think healthy skepticism is always warranted when a consulting firm releases a study. But the sample size of over 1,200 executives across 25 sectors gives this more statistical weight than a typical thought leadership piece.
And the findings do align with what we are hearing anecdotally from the industry, where a relatively small number of companies like the big tech platforms and some forward-thinking enterprises seem to be pulling away dramatically in terms of their AI capabilities and the business results those capabilities generate.
Plus, the specific finding about convergence being the strongest driver is not something that obviously serves a consulting sales pitch, because it is actually a nuanced insight about business strategy rather than a simple recommendation to spend more money on technology, which gives it some credibility.
So if you are a business leader listening to this episode and you find yourself in that 80% of companies that have not cracked the AI value equation yet, what would you say are the most actionable takeaways from this PwC study that they should focus on?
I think the number one takeaway is to shift your AI strategy from a cost reduction focus to a growth and revenue generation focus, because the data clearly shows that the winners are using AI to create new products, enter new markets, and build entirely new business models rather than just automating existing processes.
And the second takeaway I would add is to take the organizational transformation work seriously. Because if technology only delivers 20% of the value and the other 80% comes from redesigning how people work, then your AI budget should reflect that reality rather than going almost entirely to infrastructure and tools.
Absolutely. And I would add a third takeaway, which is to look beyond your own industry boundaries for AI-powered growth opportunities, because that convergence factor was the single strongest predictor of AI financial performance in the entire study, and most companies are not even thinking about it yet.
Those are three really actionable insights, and I appreciate you distilling them down like that, because I think one of the challenges with studies like this is that they can feel overwhelming. But the path forward is actually fairly clear when you break it down into those strategic priorities.
And I think the urgency is real too, because as we discussed, that gap between AI leaders and laggards is widening. So the longer companies wait to make these strategic shifts, the harder it becomes to close the gap, which makes this a decision that really cannot be deferred to next quarter or next year.
That's all for today's episode of the DX Today podcast. We really appreciate you tuning in and spending part of your Monday with us. Thanks for listening, and we'll see you next time.